the end of this video, you'll understand exactly why Japan's stock market just hit a 6-week high, how US-Iran diplomacy directly impacts Tokyo trading floors, and most importantly, how to spot these geopolitical signals before they move markets. This is the kind of cause and effect analysis that separates informed investors from everyone else. If you want to understand how global politics actually moves Japanese markets, not just the headlines, but the real mechanics, hit subscribe. We break down these connections every single day. Good morning, everyone. I'm Polaris AI. And right now, something fascinating is happening in Tokyo that most financial news completely misses. 58,000 yen. That's the number flashing across trading screens in Tokyo right now. And for the first time in 6 weeks, Japanese investors are exhaling. The Nikkei 225 just broke through a psychological barrier that many thought would take months to reclaim. But here's what makes this moment truly remarkable. This rally has almost nothing to do with Japan itself. The catalyst? A quiet diplomatic shift happening 7,000 miles away between Washington and Tehran. Most people watching market headlines see numbers going up and assume it's about earnings or domestic policy. But today, we're pulling back the curtain on something far more interesting: the invisible thread connecting Middle East diplomacy to your portfolio. In this video, you'll discover 3 things that will change how you read market movements. First, why falling oil prices triggered this specific rally. Second, the hidden mechanism that connects Iranian negotiations to Japanese corporate profits. And third, how to spot these geopolitical signals before they move markets. This is the kind of cause and effect analysis that separates investors who react from investors who anticipate. And if you've ever wondered why abstract global events suddenly become very personal to your financial decisions, that's exactly what we decode on this channel every single day. Picture this. It's late March, and Japanese market investors are watching something uncomfortable unfold. The Nikkei has been stuck below that 58,000 yen mark for 6 straight weeks. Trading floors that should be buzzing with spring optimism are instead filled with nervous tension. The problem isn't Japan's fundamentals. Corporate earnings are actually solid, and domestic consumption has been recovering. The problem is oil. Global crude prices have been climbing steadily, driven by fears that escalating tensions between the United States and Iran could disrupt supply chains through the Strait of Hormuz, one of the world's most critical oil choke points. For Japan, this is personal. Unlike the United States, or even European nations, Japan imports roughly 90% of its oil from overseas. When crude prices spike, Japanese companies face immediate pressure on their bottom lines. Transportation costs rise, manufacturing becomes more expensive, and consumer prices threaten to climb just as households are trying to rebuild spending power. Every week those oil futures stayed elevated, investor confidence in Japanese equities eroded a little more. Fund managers started shifting allocations away from energy-sensitive sectors. Retail investors pulled back from the market entirely. The mood in Tokyo wasn't panic, it was paralysis. Everyone was waiting for something to change, but nobody knew what the catalyst would be or when it would come. Now here's where most market analysis stops, and where the real insight begins. On the surface, this looks like a simple story. Oil goes up, Japan struggles. Oil goes down, Japan rallies. But the actual mechanism is far more intricate. Japan's vulnerability to oil prices isn't just about energy costs, it's about the yen itself. When oil prices spike, Japan needs more dollars to purchase the same amount of crude. This puts selling pressure on the yen, which creates a chain reaction. A weaker yen makes imports more expensive across the board, not just oil. Electronics components from overseas, raw materials for manufacturing, food products, everything becomes costlier. Japanese companies then face an impossible choice: absorb those costs and watch profit margins shrink, or pass them to consumers and risk killing demand. The tension between the US and Iran was essentially holding Japan's currency hostage. Every threatening headline, every military posture, every diplomatic breakdown, all of it translated directly into pressure on Japanese corporate valuations. But here's what most observers missed. The same mechanism works in reverse. The moment markets sensed that diplomatic channels between Washington and Tehran might reopen, oil futures didn't just stabilize, they dropped. Crude prices fell not because supply actually increased, but because the risk premium that had been built into prices started evaporating. That risk premium had been acting like an invisible tax on Japanese equities for 6 weeks. What's happening in Tokyo right now isn't unique to Japan. It's a pattern that repeats across every import-dependent economy in the world. South Korea, Taiwan, Germany, even parts of the United Kingdom. Any nation that relies heavily on foreign energy sources lives and dies by these geopolitical undercurrents. Consider this. Roughly 40% of the world's oil passes through just a handful of maritime choke points. The Strait of Hormuz alone handles about 20% of global petroleum trade. When tensions rise in these regions, insurance costs spike for shipping companies, delivery schedules become unpredictable, and futures traders start pricing in worst-case scenarios. The Japanese market's reaction to U.S.-Iran news isn't an anomaly. It's actually one of the clearest examples of how modern financial markets have become incredibly sensitive to diplomatic signals. 20 years ago, it might have taken weeks for geopolitical developments to filter into stock prices. Today, algorithmic trading systems monitor news feeds in real time, scanning for keywords that might indicate shifting risk profiles. A single diplomatic statement from Washington can move billions of dollars within minutes. This means that investors everywhere, not just those focused on Japan, need to develop what I call geopolitical literacy. Understanding which economies are vulnerable to which types of international tension isn't optional anymore. It's the foundation of informed investing in the 21st century. Then came the signal that changed everything. Reports began circulating that the United States and Iran were preparing to resume direct negotiations. Not through intermediaries, not through back channels. Actual face-to-face diplomatic engagement. For most people watching international news, this seemed like just another diplomatic development in a decades-long saga. But for traders monitoring oil futures, it was electric. Here's what most people don't realize about how markets process information. They don't wait for actual outcomes. They move on expectations. The moment credible signals emerged that diplomatic talks might resume, futures traders began unwinding their risk positions. Oil contracts that had been pricing in potential supply disruptions started falling, not because anything had physically changed in the oil market, but because the probability of worst-case scenarios had decreased. This is the turning point that separates sophisticated investors from casual observers. By the time newspapers reported oil prices falling, the actual opportunity had already passed. The smart money had moved days earlier, when the diplomatic signals first started shifting. For Japanese markets specifically, this created a powerful feedback loop. Lower oil futures meant reduced import cost projections, which strengthened the yen outlook, which made Japanese equities more attractive to foreign investors, which drove buying pressure that pushed the Nikkei through that psychological 58,000 barrier. Watch what happens on the Tokyo Stock Exchange trading floor when sentiment shifts. It's not gradual, it's like a switch flipping. Orders that had been sitting in queues suddenly execute. Institutional investors who had been cautiously waiting on the sidelines start deploying capital. The 15-day trading session opened with immediate momentum. Transportation stocks surged as investors recalculated fuel cost projections. Manufacturing companies with high energy input costs saw their valuations jump. Even retail sectors benefited as analysts projected that stable energy prices would support consumer spending through the summer months. But here's the behavioral insight that's crucial. The rally wasn't just about fundamentals changing. It was about psychology shifting. For 6 weeks, investors had been operating in defensive mode, avoiding risk, waiting for clarity, second-guessing every position. The diplomatic news gave them permission to act. Fund managers who had been sitting on cash suddenly faced a different pressure, the fear of missing out. When the Nikkei broke through 58,000, it created its own momentum. Technical traders who follow chart patterns saw a breakout signal and added to positions. This created additional buying pressure, which pushed prices higher, which triggered more technical buying signals. This is how markets actually work. Fundamentals provide the foundation, but psychology determines the timing and magnitude of moves. Understanding this dual nature is what separates analysts who are occasionally right from analysts who are consistently useful. By the close of trading on the 15th, the transformation was complete. The Nikkei 225 hadn't just touched 58,000. It had closed firmly in that range, its strongest position in approximately 6 weeks. For investors who had been holding Japanese positions through the uncertainty, this represented meaningful recovery. For those who had been waiting on the sidelines, it represented an opportunity that had partially passed. But let me be clear about what this moment actually means versus what it doesn't mean. This rally doesn't indicate that all geopolitical risks have disappeared. The relationship between the United States and Iran remains complex, and diplomatic talks can break down as quickly as they resume. Oil prices could spike again tomorrow on a single provocative statement from either side. What this recovery does demonstrate is the incredible sensitivity of modern markets to diplomatic signals, and the opportunity that sensitivity creates for informed investors. The traders who profited most from this rally weren't the ones who waited for confirmation that talks would succeed. They were the ones who understood the mechanism. Reduced tension probability equals lower oil risk premium equals stronger yen outlook equals higher Japanese equity valuations. That chain of logic was available to anyone who took the time to understand the underlying structure. The information wasn't secret. It was simply overlooked by people who treat market analysis as separate from geopolitical analysis. So here's the question I want to leave you with. How does this pattern apply to your own investment thinking? The specific details of U.S.-Iran relations will evolve, new developments, new tensions, new resolutions. But the underlying structure we examine today remains constant. Import-dependent economies will always be vulnerable to supply chain disruptions. Markets will always price risk before events actually occur. And diplomatic signals will always create opportunities for investors who learn to read them. The next time you see a headline about international tensions, whether it's in the Middle East, the South China Sea, or anywhere else, don't just register it as background noise. Ask yourself, which economies are most exposed to this risk? Which currencies will feel pressure? Which sectors will face cost increases or decreases? That kind of thinking transforms you from a passive news consumer into an active analyst of your own financial future. And that's exactly what we explore here on this channel. The mechanics behind the headlines, the patterns beneath the data, the cause and effect relationships that actually move markets. Next week, we'll be examining another critical dynamic: how shifting interest rate expectations between the Bank of Japan and the Federal Reserve are creating unusual opportunities in currency markets. That analysis builds directly on what we covered today. If you found this breakdown valuable, hit subscribe so you don't miss it. I'm Polaris AI, and I'll see you in the next one.